Imagine buying $1 million stake in this prime commercial high-rise in Dubai, and you're paying for it using Bitcoin.
Right.
But the kicker is, the entire transaction settles with absolute legal certainty in, like, near 0 seconds.
Which is wild to even think about.
It totally is. And imagine doing all of this without violating a single rule of centuries-old Islamic financial law.
Yeah, that's the really fascinating part.
Right. So today, we are bringing you along on a really specific, really fascinating mission. We're looking at how the ancient, heavy stone fortress of traditional finance is being wired with fiber optic cables.
And entirely automated by code, too.
Exactly. Welcome to the deep dive.
It is just a profound structural shift, honestly. We're looking at a system that, historically requires mountains of paperwork.
Oh, the endless paperwork?
Right, and layers upon layers of intermediaries. And we are just stripping all of that away to replace it with programmable mathematics.
And our guide for this exploration is this really insightful piece titled Asset Tokenization, a value proposition for Islamic Financial Institutions, or IFIs.
Yeah, written by Fahad Siddiqui.
Right, the CEO of Almabrook Financial. And he frames this entire discussion around a theme he calls Fintech Meets Faith.
Which is such a great way to put it.
It really is. So the mission here is to understand how distributed ledgers are taking massive, illiquid, real-world assets.
Like that high-rise in Dubai.
Exactly. Taking those and slicing them up into digital tokens. The ultimate goal is making the financial world faster, globally accessible, and crucially, fully Shariah-compliant.
And that compliance factor is really what elevates this beyond just, a standard tech discussion.
Also,
Well, we aren't just talking about building new financial plumbing here. We are looking at how to modernize global finance while hard-coding a very strict set of ethical guidelines directly into the software itself.
it's like upgrading the global financial system's operating system to run at lightning speed, while ensuring the strict, ethical rulebook of Islamic finance is hard-coded right into the software.
That's a perfect analogy, yeah.
Okay, let's unpack this. Before we get to the digital tokens and the fractionalized skyscrapers, we really have to go down into the engine room.
We do, yeah. Because if a major Islamic bank is going to trust a digital ledger with, billions of dollars of client assets, that ledger has to be virtually indestructible.
Right, it can't just be some server sitting in a basement.
Exactly. And Siddiqui starts by establishing this exact foundation. He talks about distributed ledger technology, or DLT.
Right. So to understand the leap forward here, we really have to think about the friction in the current system.
Yeah, because traditionally, data is highly centralized. A bank holds the ledger on its own private servers.
And if you want to know who owns what, you basically have to query the bank.
You do. And you have to trust that the bank's internal security hasn't been breached, right? Or that some rogue employee hasn't altered a record.
Which happens.
It definitely happens. But DLT flips that architectural model entirely on its head.
Right. Instead of one central server holding the absolute truth, identical copies of the ledger are distributed across a vast global network of independent computers.
Right. Those are called nodes.
But wait, if thousands of computers all have a copy of the ledger, how do you stop a bad actor from just going into their copy, adding a few zeros to their bank balance, and telling the rest of the network it's legitimate?
That is the million-dollar question.
Because the source mentions timestamping, but I really want to get into the actual mechanics of how that prevents tampering.
So it really comes down to cryptographic hashing.
Hashing.
Yeah, hashing. When a transaction occurs, the network runs the details of that transaction, like who sent what to whom and at what exact millisecond, through a really complex mathematical algorithm.
Okay.
And this generates a unique string of characters called a hash. It's essentially a digital fingerprint.
Right.
But here's the genius part. Every new block of data includes the digital fingerprint of the block that came immediately before it.
Oh, wait, so they are mathematically fused together.
Precisely. They are inextricably linked. If someone tries to retroactively alter a record on their local copy of the ledger, say, changing a transaction from last week,
The fingerprint changes.
instantly, the mathematical output for that block instantly changes, and because that block's fingerprint changed, it no longer matches the reference in the subsequent block.
So the whole chain just breaks.
Exactly. The entire chain of data essentially shatters. So when that altered node tries to broadcast its version of the truth to the network,
The other nodes reject it.
yeah, the other thousands of nodes look at it, see the math doesn't align with their collective history, and automatically reject the fraudulent record. It secures the data through mathematical consensus rather than relying on, a central authority.
Wow. This actually clears up a massive misconception, because the source makes a very specific point to distinguish between DLT and blockchain, which people constantly use
Not
interchangeably.
constantly, yeah.
So if DLT is like a shared, indestructible, continuously updating spreadsheet that everyone can trust because of that cryptographic math, a blockchain is just one specific way of organizing the rows and columns.
That is a highly accurate way to visualize it. Yeah.
Yeah,
Blockchain is just a specific implementation of DLT where data is concatenated into sequential blocks, forming a literal chain.
right.
But DLT is the broader umbrella. What's fascinating here is, because it's an open framework, DLT allows for different types of what they call consensus procedures.
Like the rules for how everyone agrees on the data.
Exactly. The specific rules the network uses to agree on what gets written into that indestructible spreadsheet in the first place. Siddiqui notes the two primary mechanisms. You've got proof of work and proof of stake.
Okay, let's translate those into plain English for everyone listening, because the underlying logic is honestly fascinating. Proof of work is essentially a computational brute force competition, right?
Yeah, pretty much.
It's like having thousands of miners racing to solve a massive, incredibly complex Sudoku puzzle.
Right. And the first one to solve the math puzzle earns the right to rate the next page of the ledger.
And they get a small reward for their effort.
Mm.
But it requires a tremendous amount of electricity and computing power to prove they put in the quote-unquote work.
Yes, which makes it highly secure but notoriously energy intensive. I mean, it burns a lot of power.
Right.
Proof of stake, on the other hand, replaces that computational puzzle with financial skin in the game.
Skin in the game.
Yeah. So instead of burning electricity to validate transactions, participants lock up a portion of their own digital assets in a smart contract. They basically put their money in escrow.
Oh, I see.
And if the network randomly selects them to validate the next block of transactions, and they attempt to validate a fraudulent record,
They lose their money.
exactly, the network slashes their staked funds, they lose their own money. It enforces honesty through economic consequence rather than, computational friction.
So we have this incredibly secure, decentralized, tamper-proof ledger, whether it's secured by computational puzzles or financial escrow.
Right.
But an empty ledger doesn't do us any good. We have to put something of value on it.
Mm-hmm.
And this brings us to the core of Siddiqui's piece, moving from the tech to the tangible through asset tokenization.
This is exactly where we bridge the digital divide. Asset tokenization is essentially the process of converting off-chain, real-world assets into digital tokens that signify ownership on the DLT.
Okay.
But these tokens are not just static, digital PDFs proving you own something. They are governed by smart contracts.
That's the code.
Exactly. A smart contract is self-executing code living right on the ledger. It's programmed with basic if-then logic.
So if a certain condition is met, the contract automatically executes an action without needing a human intermediary to approve it.
You've got it.
Now, Siddiqui provides a really comprehensive framework for what we're actually tokenizing, breaking the landscape down into 4 distinct categories.
Yeah.
Let's walk through these, starting with the first one, securities.
Right. So traditional financial instruments, equities, bonds, funds. In the Web 3.0 world, these become fungible security tokens.
Sure.
The source uses the example of a Sukuk, which is an Islamic financial certificate. It's similar to a bond, but structured to generate returns without charging interest.
Because interest isn't Shariah-compliant.
Right. Now, traditionally, trading a Sukuk on secondary markets involves a lot of administrative drag. It's slow. But if you tokenize the underlying assets of that Sukuk on a distributed ledger, each token represents a proportional slice of ownership.
And fungible simply means they are completely interchangeable, right?
Exactly.
Like one token representing that specific Sukuk is fundamentally identical to another token of that same Sukuk. Just like a $1 bill holds the exact same utility as any other $1 bill.
Spot on. It creates a highly liquid, easily tradable environment.
But the real friction in the current financial system isn't necessarily with standard securities, is it? It's with the second category, tangible assets.
Oh, absolutely. The highly illiquid asset classes.
Hmm.
We are talking about commercial real estate, fleets of vehicles, fine art, collectibles, even private businesses.
Items that are notoriously hard to sell quickly.
Right. Tokenizing these turns them into non-fungible security tokens.
Meaning they are entirely unique to the specific asset they represent.
Yes. And the implications here are just staggering. Normally, transferring ownership of an office building takes months. You have title searches, legal reviews, escrow periods.
That's a nightmare.
It is. But by representing that title as a unique token on a secure DLT, transferring ownership of that building becomes as mechanically simple as sending an email.
That drastically changes the velocity of capital. I mean, it's wild.
Yeah.
Okay, so the third category Siddiqui outlines is currencies, specifically fiat money.
Right. So when traditional fiat money like dollars or euros is represented on the distributed ledger, it becomes a payment token.
Like a stablecoin.
Exactly. You will widely hear these referred to as stablecoins, or in a government context, central bank digital currencies.
And their entire architectural purpose is to maintain parity with the traditional currency.
Right. They provide the stable, predictable medium of exchange required to facilitate business on the blockchain without exposing the parties to wild price swings.
Which perfectly sets up the friction we hit in the fourth category, cryptocurrencies. Unbacked digital assets like Bitcoin or Ethereum.
Yeah, this is where it gets nuanced.
Because the source labels these as payment tokens as well. But Siddiqui specifically notes that selling cryptocurrency that is not backed by tangible real-world assets is actually not Shariah-compliant.
That's right.
But then, in almost the exact same breath, he states that an investor can use that unbacked cryptocurrency as a medium of payment to buy investment tokens, like the Mabrook token. I need to pause here because this sounds like a massive contradiction to me. How does a non-compliant asset suddenly become a compliant tool?
I know, it sounds totally contradictory until you really examine the underlying ethical mechanics of Islamic finance.
Okay, walk us through it.
So, the prohibition against investing in unbacked cryptocurrencies stems from the principle of avoiding gharar.
Gharar.
Yeah, which basically translates to excessive uncertainty or speculation.
Ah, I see.
An Islamic investment must be tied to something with intrinsic real-world value, a physical asset, a functioning business, a tangible service.
Something real.
Right, because assets like Bitcoin are not backed by physical reserves or cash flows. Speculating on their future price is viewed as violating that principle. There is no underlying, there to generate legitimate economic value.
So holding Bitcoin, just hoping the chart goes up, violates the rule against speculation.
Exactly.
But money itself, as a functional medium of exchange to facilitate trade, is a recognized necessity.
You hit the nail on the head. What Siddiqui is clarifying is the difference between an asset and a rail.
An asset and a rail.
Yeah. An Islamic investor cannot ethically purchase unbacked crypto as the investment portfolio itself.
Right.
However, the blockchain networks that these cryptocurrencies run on are incredibly efficient global payment rails.
Oh, so the investor is permitted to use the cryptocurrency purely as a transactional bridge, like a fleeting medium of exchange.
Exactly. They use it just to purchase something that is fundamentally backed by a tangible asset.
I want to make sure this mechanism is crystal clear for everyone. Let's say I'm an investor sitting in London.
Okay.
And I want to invest in a Shariah-compliant commercial plaza in Dubai. In the traditional system, I have to deal with international wire transfers, foreign exchange fees, correspondent banks, and days of settlement delays.
At best, days.
Yes. But in this Web 3.0 model, I can take my capital, temporarily convert it into Bitcoin for the sheer utility of its global liquidity, send it across the world in minutes, and instantly use it to buy a Mabrook token.
Right.
Which is a digital token firmly backed by the physical bricks and mortar of that Dubai plaza.
That is the exact use case. The investor is utilizing the technological superiority of the crypto network without violating the ethical prohibition against speculation, because the final destination of the capital is a tangible, compliant asset.
That is fascinating.
If we connect this to the bigger picture, it is just a brilliant synthesis of ancient financial principles and cutting-edge technology.
It really is.
Right.
And it brings us to the most transformative part of this entire process. We know we can put a commercial plaza on a blockchain, but why go through all that technical engineering just to have a digital deed?
Right, what's the point?
Exactly. The real power unlocks when we realize that once a multi-million-dollar building is represented digitally, we can basically use a pair of scissors on it.
Asset fractionation.
Yes.
The source material provides a very striking visual to illustrate this concept. It shows a drawing of a skyscraper, and then it shows the building being systematically cut down the middle.
Just sliced right up.
Yeah, broken into smaller and smaller structural pieces. And those pieces are then represented by distinct digital coins, which are distributed among a wider group of people, labeled in the diagram as Mabrook investors A, B, C, and D.
Here's where it gets really interesting. Think about the last time you tried to diversify your personal portfolio By picking up a piece of prime commercial real estate or a multi-million-dollar piece of fine art.
You probably didn't.
Exactly, you didn't, because the minimum buy-in for those asset classes historically locks out like 99% of the population.
Easily.
But by tokenizing that exclusive skyscraper, it becomes a digital jigsaw puzzle.
Yeah.
You don't need $50 million to buy the building. You just need $50 to buy one puzzle piece.
And that fractionation fundamentally alters the financial ecosystem in two very distinct directions.
How well?
First, it broadens the sources of capital for the developers or the businesses. Historically, if a Shariah-compliant project needed funding, the founders had to approach a few massive institutional banks or high-net-worth gatekeepers.
Which is a super slow, highly centralized bottleneck.
Very slow. But by fractionalizing their equity into tokens, they instantly bypass that bottleneck and access a truly global pool of micro-investors. Capital formation becomes drastically more efficient.
And it flows the other way, too. It broadens the investment universe for everyday people.
Exactly.
It democratizes access to historically gated asset classes, allowing a much deeper level of portfolio diversification.
It really opens the doors.
But let's look at the mechanics of this again. If I own one tiny digital puzzle piece of a skyscraper in Dubai, how do I actually get my share of the rental income? Do I have to rely on a property management company to mail me a check for $3 every month?
Oh, no. This brings us right back to the smart contracts we discussed earlier.
The code on the ledger.
Right. The smart contract acts as the automated administrator. When the commercial tenants in that Dubai skyscraper pay their monthly rent, that fiat currency is converted into a stablecoin on the ledger. The smart contract continuously scans the blockchain, sees exactly which digital wallets currently hold the puzzle pieces of that building, and instantly routes the exact proportional fraction of the rent to those specific wallets.
Wait, really? No property manager?
None at all. There is no human property manager cutting checks, no administrative overhead, and no delay. It is entirely programmatic.
Wow. Which perfectly sets up the operational reality for the guys running the heavy stone fortress. Slicing up assets and receiving automated dividends is incredible for the individual investor. But what is the bottom line for the Islamic financial institutions themselves?
Why should a bank care about decentralizing its own ledger?
Regulate.
Because the systemic operational advantages are just too massive to ignore. Siddiqui details severe business benefits for IFIs that adopt this infrastructure. We are talking about a radical reduction in transaction costs.
Because you're cutting out the middlemen.
Exactly. Because the smart contract handles the execution, clearing, and settlement automatically on the DLT, you eliminate the need for layers of middle office administrators, clearinghouses, and compliance auditors, manually verifying the same piece of paper over 3 business days.
It's a complete elimination of administrative bloat.
It is. This automation significantly lowers operational risks by removing human error from the equation. And Siddiqui drives this home with the metric every executive cares about. This technology fundamentally reduces an Islamic bank's cost of operations, which directly and aggressively increases its net profit margin.
The NPM.
Exactly.
But the source goes beyond just saving money, doesn't it? It talks about settling customer transactions in near 0 seconds. And it emphasizes providing flawless traceability using the blockchain to gain customer trust.
Yes, and for an Islamic bank, proving compliance isn't just some regulatory hurdle. It is the entire foundation of their product.
Right. If it's not compliant, it's not valid.
Exactly. Trust is their ultimate currency. In traditional systems, proving that a complex financial product is completely free of hidden interest, or proving that an asset hasn't been doubly leveraged, requires expensive, time-consuming audits.
But on the blockchain.
The blockchain provides an immutable, transparent audit trail by default. Anyone can verify the history and backing of a tokenized asset in real time.
Which is huge.
Huge. Siddiqui argues that combining the speed, efficiency, and absolute mathematical transparency creates a major unique selling proposition. It readies these institutions to dominate in what he describes as a metaverse Web 3.0 and 4.0 world.
Okay, I have to push back here, or at least inject some operational reality into this vision.
Sure.
Siddiqui's white paper makes near 0 seconds sound like an inevitability. But traditional Islamic banks are massive, slow-moving entities weighed down by decades of legacy tech debt, intensely rigid regulatory frameworks, and entrenched corporate cultures. Can they actually just flip a switch to Web 3.0 and suddenly settle international real estate trades in 0 seconds? The migration alone seems like it could bankrupt a smaller institution.
You are identifying the central friction point of this entire technological revolution. No, they absolutely cannot just flip a switch.
Right.
The institutional migration to DLT is grueling. It requires running parallel legacy and blockchain systems for years, navigating uncharted regulatory sandboxes with central banks, and entirely retraining compliance departments to audit code instead of paper.
It sounds like a nightmare.
It is an incredibly painful, expensive transition. But the implicit warning beneath Siddiqui's entire value proposition is clear. The friction of upgrading is painful, but the cost of ignoring it is fatal.
Adapt or become obsolete.
Exactly. If a new, agile fintech challenger is offering mathematically proven, Shariah-compliant asset transfers that settle instantly on a smartphone.
Well, the legacy bank makes you wait 3 days for paper certificates?
Right. If the legacy Islamic bank is still requiring customers to wait 3 days for paper certificates to clear through correspondent banks, the legacy institution will simply bleed its customer base to death. It is not just an upgrade, it is an evolutionary imperative.
It really is a paradigm shift. Which brings us to the end of our deep dive. We've covered a massive amount of ground today, pulling from Fahad Siddiqui's insights on where fintech meets faith.
We really did cover a lot.
We started deep in the engine room, exploring how cryptographic hashing and decentralized consensus create an unbreakable, time-stamped foundation. A distributed ledger technology far broader and more capable than just a basic blockchain.
Right.
From there, we looked at how the real world moves on-chain, utilizing smart contracts to tokenize everything from fungible securities like Sukuks to non-fungible assets like real estate.
The tangibles and the intangibles.
Exactly. We navigated the ethical mechanics of Islamic finance, breaking down how unbacked cryptocurrency violates the rule against speculation, but can ethically serve as the high-speed rail to purchase tangible, compliant assets like the Mabrook token.
A very crucial distinction.
Then we saw the skyscraper sliced into digital puzzle pieces, proving how asset fractionation democratizes the investment universe. And finally, we examined the stark reality for Islamic financial institutions. Embrace the near-zero-second settlements and automated compliance of Web 3.0, or risk irrelevance.
Adapt or die, basically.
So what does this all mean for you? It means the architecture of global wealth is being fundamentally rewritten.
It really is.
The future of finance is highly fractional, it is blindingly fast, and it is universally accessible, regardless of whether you're a sovereign wealth fund managing billions or a single investor in a coffee shop buying a $50 slice of a commercial plaza.
A whole new world.
But I want to leave you with a final thought to mull over, kind of circling back to where we started with that image of the heavy stone fortress. If every physical asset in our world, from the car in your driveway to the art on your wall to the equity in your business, can be tokenized, fractionalized, and fluidly traded across global ledger in milliseconds, does our traditional concept of owning something start to disappear, or does it just become perfectly fluid?
That is a fascinating question.
Something to think about. Until next time, keep diving deep.